you?
I'm good. How are you?
Good. Coming out of Vegas and family reunion, what's your
Yeah.
big ahas?
Um, my big aha is kind of where we were last year, which is we need to keep doubling down on the basics and doing more of it.
Yeah, there's a value proposition. I think they're calling it value squared is my big takeaway. Like we've got to really get clear on value propositions and who we are as a real estate profession to the consumer. So you will
Just
see
think if
more and
everyone
more of
did
that.
that right now, if we could, snap our fingers and all of a sudden everyone had a professional presentation for buyers and sellers, how different our industry would look.
Absolutely. All right, so we've got a lot to jump through today, so I'm going to hit it. Let's start Fulton County. We we have 810 active inventory. Big jump from last week.
Hmm.
That's the most inventory we've had since October last year. So I feel pretty encouraged by that inventory number. We jumped quite a bit from 88 last week to 137 and active under contract. That's a good, healthy number of houses going under contract.
Hmm.
Um, 40 coming soon. I like that. 328 pending, which just keeps it's sometimes I feel like I'm a broken record when we go through these, but the point of it is that spring market is building and building and building and houses are moving. Um, you look at the closings, we had 260 the last 7 days, which included the last end of the month,
Right.
and then 160 the week before. You just kind of look back. Uh, we definitely are selling more houses right now.
Hmm.
And I see that as such a positive sign. If I hit DeKalb County, uh, boom, boom. Come on, cursor. All right, we've got 424. Look at that jump in inventory, almost 200 inventory jump in DeKalb County, 96, almost double active under contract over last week. 192 pending, which is really healthy. And then if we just come down here to that 142 closed number, there was 265 properties that closed in the last 2 weeks in
Hmm.
DeKalb County. Really, really healthy. 57 expireds. There's still properties not selling, which is crazy to me. And for Cobb County, 382 active inventory. Last week seemed to be a low week, but it was 376 the week before. So 382, pretty healthy number. 91 active under contract. We had a couple of weeks where 90 was, we popped in the 90s. So I feel good about that. 171 pending, maybe a little off what we had seen earlier in February, but the real number is this 157 closings. Um, just looking back, you got to go all the way back to December to see any kind of number close to 157 in the
Right.
closing. So what do you see in the numbers?
Well, I mean, it's kind of typical for um, sellers who are looking to sell their house in the spring to wait for March 1st to come around and put it on the market. And I think that's what we're seeing here. If you look at all the new listing numbers, that's what's happening is more people are putting their homes on the market, which is consistent with the seasonality of spring.
Absolutely. I also think I asked myself the question, are we selling more houses this year than we did last year? I believe so. I feel so. I think we'll know more as the data starts pouring in
Yeah,
month over month comparisons, but right now it sure feels that way, right?
for
Um,
sure.
so Gary Keller always does his vision speech. And if you just go to therealestatestats.com, click on the national statistics, Luke uploaded all these this morning. So we now have the new slides on here. But I wanted Mark just to go through these 7 things this
Hmm.
morning because I think these are the numbers that drive US real estate, right?
Right.
And just for purposes so you understand, we take these slides, and if you click on Atlanta statistics, we mirror these slides specifically for Atlanta. That's the whole point of why we do what we do. But let's talk national this morning. Um, so here's the national home sales. So I don't think it's new information that there were 4.1 million transactions in 2023. I think it's worthy of pointing out that's 8.2 million units as far as we're concerned, because there's a buyer side and a seller side. Yet it was the lowest year on record for a long, long time. However, what you should see is the projections are that we will sell more transactions in 2024 than we did in 2023. Not quite what we were selling before, but we're climbing back up. And this is a unit count statistic. And then if you look at this, Mark, on a monthly basis, in
Right.
January 22 compared to January 23, look at the size of the gap in transactions.
Hmm.
And as the year went on, that gap got smaller and smaller.
Right.
And our projections are that the gap's going to start to get wider and wider going forward in our favor,
Right.
meaning we've probably sold more houses in January than we did the previous January. We expected to sell more houses in February than we did the previous February. We'll see it as the data starts pulling in.
Hmm.
But I think it's an interesting graph just to look at. What do you see in that?
Yeah, it's definitely on the trajectory of a recovery. I think the biggest question we have is, when rates do get lowered by the Fed in, let's say, May, which is what they're projecting, how big of an impact is it going to have on that, and how long will it take for it to have that effect? So it'll be really interesting, because in an election year, you sort of expect for most of the sales to happen by, September. And with if there is a May boost, uh, courtesy of the Fed with lowered interest rates, it'll be interesting to see that may create a second wave of demand at the end of this spring.
Yeah. Luke just texted Mark, you and I. He said, just looking at 2024 January to 2023 January, we have overcome the 2023 numbers of units sold. So we know for January what we're saying is true.
Hmm.
And we're waiting on February, obviously.
Yeah.
All right, home prices. So the green or the teal line, I guess you would say, is the 4% annual long-term trend of price appreciation. So you had this period before the Great Recession where the prices peaked at 24% above the trend line. And then home prices went down. So if you bought a house in 2006 and the prices went down, you weren't a very happy consumer. But you should notice if you bought a house in 2011, the price appreciation line was straight up. So most people know we make the statement, you make all your money on a house in the purchase, right? From an investment standpoint, certainly from an equity standpoint. So the reality is, when we recovered during the pandemic and prices went above the trend line, they peaked at about 9% above the trend line, which is drastically different than 24%.
Hmm.
So it's above the trend line, but it's not 24% above, it's 9% above.
Right.
And you also should notice on here that the projections are that there's still going to be price appreciation in 2024 to the tune of $8,000, or you could call it 2%, right?
Right.
Anything else on this chart that you think is worthy of making a mention?
Just the fact that, like being that high above the trend line, it also is why it dipped so bad when that bubble burst in 2007, 2008. So,
100%.
I think being at a lower increase now, we don't really have a bubble. And the projections are that it's not going to go down, it's going to continue to go up, but just, not at quite a fast pace.
Absolutely. And I think this tells an interesting story. So this is different periods of time and what price appreciation did in those periods of time. So from 1990 to 2000, price appreciation was basically the 4% trend line, 3.9%. Then we went through a hyper appreciation period from 2001 to 2005 where values of houses were going up a lot, almost 9%. Then the Great Recession averaged a negative 4.4% on price. But then we went through the recovery. The recovery from 2012 to 2019, just before the pandemic, averaged 6.4% price appreciation, where
Which is pretty
the
amazing.
at the bottom was 4.9%.
Right. That's a
And
strong
then
market.
we went through pandemic market, right, which
Mhm.
averaged 12.5%. But right now they're saying they're expecting the average of last year and this year to be, call it 2% price appreciation. That doesn't sound like a lot until you compare it to a negative 4.4%.
Right.
And then you go, oh, I like my 2%. Because after you follow a period of big price appreciation, historically, there's been depreciation, big price appreciation, small price appreciation, which I think is a really, really good sign for us.
Hmm.
Um, I thought this chart, which showed a lot of the economic things, the political things, uh, all those things that cause pricing to go up, down, things like that. Look at the price right here, the 21.35% uh, price appreciation in March of 2022. That's crazy.
It is.
Then we went back down here, but what you need to see is we didn't go down here.
Right.
We've already bounced off the bottom and it's going to be flat for a period of time,
Right.
but it'll
And
be positive flat, not negative flat.
well, and I also have to say, like, a big reason that we didn't go down that far is because the Fed raised rates and because they put the brakes on the economy and on inflation. So we didn't continue to drop like we could have.
100%. So we didn't like it,
Right.
but we're going to like it in the future.
Overall, it's the good thing. It was the right thing to
Yeah,
do.
100%. So this slide I find really interesting, and I'm going to make a controversial statement. But before I do, um, 2023 was $2.09 trillion worth of real estate was transacted. So
Hmm.
in by definition, that was the third largest year of dollar amount of real estate changing hands. Did it feel like that? No. Um, is that a reality? Yes. So what you have to get your head wrapped around is there's going to be $2.2 trillion worth of real estate transacted this year, which is a lot of real estate. However, there's a comparison between units and volume. And here's the controversial statement: you're going to make more money. There's more income to be made in the real estate industry on less transactions. That's a true statement. The way you hear it has everything to do with the controversy. So if I say you're going to make more income, less transactions, but there's more income to be made with less transactions, if you're a status quo thinker, you're going to get to go, hey, I can work less and make the same amount of money. Or if you're a scarcity thinker, you would say, "Oh my gosh, I'm not going to be able to sell enough houses this year. There's not as many transactions." But if you're an abundant thinker, you're going to say, "If I can hold my unit count equal or grow my unit count, I'm going to exponentially make a lot of money."
Hmm.
What do you hear in that statement, Mark?
I mean, it reminds me of what they were talking about at Family Reunion. The fact that we sort of stayed flat this past year instead of growing. And typically, Keller Williams grows in a down market because we have all the tools and the models and the systems to work in an adverse market. Because we don't sit there and watch it happen. We get into action. And I think the aha for me is that not enough of our people are getting into action, and it's time. Like, you have to start doing something differently.
Yep. Well, the thing is in an abundant economy, inactivity sometimes still wins.
Right.
In a non-abundant economy, I don't think we're in a scarcity economy. I think we're in a non-abundant economy right now.
Mhm.
Um, Activity or lack of activity shows up. And the people that are doing the activity, what this chart tells me is they're going to win really big income wise. And the people that are in inactivity, I don't want to say they're going to lose, but they're not going to win.
Right.
Make sense?
Yeah. And
Uh,
there's winning to be had in this market. You can take market share in this market.
Absolutely. We're sitting at 3.1 months of inventory nationwide. Um, if you look back, uh, none of these other numbers look like that number. And so that's quite interesting because they say 6 months is a balanced market. I would argue 4 months is about where the balanced market is right now. Um, yet 3.1 is still low, but it also speaks to the low transaction volume. We can only measure inventory on supply. What we
Right.
can't measure is demand. The only way we try to measure demand is through showing time reports at like how many people are looking at houses.
Mhm.
However, I will make this statement that I believe to be a true statement. I actually believe demand is high and people want to buy real estate. They just can't connect the dots in how to do it. Whether they feel like interest rates are their obstacle or they can't find the house they want to buy as the obstacle, or they're trapped in their current house with a low interest rate, which trapped is a relative term. Um, but it doesn't mean people don't want to transact real estate. I do believe there's a pent up demand of people that want to transact real estate.
For
They're
sure.
just stuck connecting the dots.
Right. Well, and I think that's where we come in as professionals to consult, right?
Yeah, for sure. And then mortgage rates, you kind of understand our mortgage rate where it is today. If you look back historically, it's actually a pretty good mortgage rate. Nobody feels that because we're coming off this low rate period, but historically, it's a pretty damn good interest rate.
Hmm.
Um, However, um, you realize in 2008, 9, and 10, we went into a great recession. And the way the government pulled us out of recession was by lowering interest rates, which is this period of time. And that's why we went so low in interest rates. But now we're resetting the market or the cost of money to be pretty historic. I mean, that's pretty in between these two lines is uh the historic interest rate over time.
Mhm.
So people just got to get used to it, is what I'm saying.
Yep.
All right. And you know about mortgage rates, treasury spend. This one I found interesting. So we talk about affordability a lot. And affordability means, can I afford the median price home on the median income in my market? And the yellow line represents the principal and interest as a percentage of income. So in 1981, people were spending half their income on their mortgage payment.
Mhm.
That's not sustainable. Then in 1998, they were spending 21%. In 2020, they were spending 18%. Now they're spending 32%. So, Mark, if I go to a lender and I want to get pre-approved for a home, what do most lenders allocate towards debt service against income? What percentage?
I mean, they're looking at 28 to 35% depending on whether they're looking at front or back end.
100%. So at 32% in 2023 lands right in the middle of that spread of percentages, meaning
Mhm.
the consumer may be a little bit out of touch with reality, and our job's to bring them back into reality.
Right.
But 32% is higher than it's been for a while, but historically it's I mean, we need it to come down slightly, probably down to about 27%, yet it's not 49%. And so from if you just use this metric of affordability, we're higher than the average between 2000 and 2023, and we're higher than the historical average, yet not much. And it's just a reality conversation. We got to bring people back in.
Mhm.
Make sense?
Yep. And
Anything else you heard in these charts? We can go through the US economy next time, but
I was just going to say that on the affordability piece, every time in history when affordability becomes a big issue, the government steps in and creates programs to facilitate home ownership for people that are struggling to get there. So helping to address the affordability problem. So I would not be surprised to see more of that happen after the election.
yeah. So I'm going to hit a couple quick things and then I want to spend time on one article. So Gary Keller made a comment. You'll probably read it. He said, right now, real estate is in a recession, meaning the economy's not in a recession, but real estate is in a recession because of the situation around affordability, around interest rates, things like that. So you can read the article on your own time, but you may read this headline and go, recession, people freak out about this word. But I do believe the real estate, home buying and sales is in a recession, which is not the same thing as an economic recession. It
Right.
just means we're depressed a little bit. I think you need to know that. This is really interesting. So you've seen the crazy looking cars driving around town called Rivians. The big plant for Rivian is basically right next to a town called Social Pilot, I think,
Social
Social
circle.
Circle, uh, which is Newton County. So there is a mass amount of new construction growth going in out the I-20 corridor east towards Covington and in Newton County. You should be aware of this.
Mhm.
Um, then the other thing, there was an article on this Channel 2 that says three corporations own 19,000 Metro Atlanta homes. What does that mean for the housing market? Well, I've known about this because these are the big and people you've never even heard of. Um, so the most recent one found that Invitation Homes Pretium Partners, which operates as Progressive Residential and Amherst Holdings, own around 11% of all the single family homes for rent in the state. So there are big institutional buyers playing in our backyard. Is it good? Is it bad? I'll keep my opinions out of it. It's just an awareness factor that I think people need to understand.
Mhm.
But this is the article I want to spend time on. So there, I find this interesting. So Mark, are you Gen X?
Yes.
I'm Gen X too. How long have you lived in your house?
Uh, I've only lived there for 4 years.
4 years. I'm Gen X. I bought my house in 2017, so I'm going on 7. I think it's an interesting conversation
Mhm.
because what they're talking about here um, are a couple of things. One is home buyers in today's market are increasingly faced with the inconvenient but inescapable truth. There are fewer homes for sale, and the ones on the market are often in need of big repairs and renovations. And I find that probably to be true. And during the pandemic, nobody cared about that because they were just happy to get into something. But now the buyers are looking at this going, shit, I got to spend a lot of money to get this house to where I want it. And it's
Mhm.
becoming a talking point again. Um, However, this is the funny part. I don't know if it's funny, but it says the housing market is caught in a generational tug of war. Boomers will soon face aging in place hurdles, while millennials will face the surprise of homes in need of major upgrades. So if you think about our market, we've had a deficit of new construction for a long period of time.
Mhm.
So most of the opportunity, especially in a metro area anyway, is going to be resale property. And resale property comes with renovation, comes with remodeling, comes with an extra cost, right? And now you throw a millennial generation at it, which by and large has no savings.
Right.
So it's going to be a little bit of a tug of war around real estate. Um, I find it interesting. It was talking here. It says the report found the length of time people stay in their homes has more or less doubled since 2006.
Mhm.
In that year, the median homeowner spent about 6.5 years in a home, which grew to a peak of 13.4 years in 2020 and dipped to 12 years in 2023. 56% of baby boomers have lived in their home for at least 10 years. 35% of Gen X lived in their home for at least 10 years. I'm at 7, and you're at 4, right?
Mhm.
Just 7% of millennials stayed in their home for at least 10 years. Um, so, of course, they're younger. I'm assuming that number will grow over time. Yet, what I read inside of this article, Mark,
Mhm.
I think this is where AI is going to light us on fire. Is you realize AI can take our database, AI can take a group of people and run an algorithm against them and tell us who's most likely to buy or sell real estate in the next couple of years, right? Um, this is part of those formulas, right?
Mhm.
And understanding what's going on. What do you see in this article? And there's a lot in this article.
Yeah, and some of this data is a little bit skewed because like I think if we hadn't had the pandemic, I never would have moved. I'd still be in the same place I was prior to the start of the pandemic. So the pandemic created a lot of movement. So a lot of people are on the lower end of that scale now.
Yep.
But that being said, I think there's going to be a lot of opportunity. The biggest question is how do you solve for that opportunity, right? Like the aging in place problem is a lot of the people that are boomers do not have a one level house. So they need a one level house as they get older. So what's the solution for that, right?
Right. 100%. we had a couple questions in the chat. I just wanted to hit before we ran out of time. Jane, you said 28 to 32% for total debt service. That's what most lenders are looking for when they pre-qualify a buyer for property. Carrington said, I've seen an increase in progress residential in my neighborhood. Is this when the HELOC comes into the conversation for owners, potential sellers? It could be. There's so many solutions these days, Mika, where a flooring company might replace the flooring, pay at closing. Maybe they tap out some of the equity in the home to upgrade it. That's where they need good counsel from you. Is it worth doing the upgrade prior to selling, or do I sell at a discount? Or how do I navigate that situation? But I don't know about you guys, but my parents' houses weren't the most upgraded houses later in life.
Mhm.
And I always thought, man, when they pass away, I'm gonna have to upgrade this thing. Like, if I inherit it, I'm gonna have to upgrade this thing. Um, so anyway, I hope today was good for you. The optimism is high, yet it's going to require your activity. So make sure you're in activity. Mark, last word.
Just, yeah, getting an activity, make sure that you're looking at your goals for the year. Where are you compared to those goals? And start having your daily conversations to hit those goals.
There you go. In and out. Have a good one.
See ya.